doctor making $300,000 a year, statistically, they're more likely to be broke than the electrician making $65,000. And it's not even close. If you're smart but struggling with money, you need to understand something. This has nothing to do with your intelligence. Your brain is actually working against you in 5 specific ways. And the worst part, you don't even know it's happening. In the next 12 minutes, we're going to expose every single trap and give you the exact fix for each one. Let's go. Welcome to Cashflow Finance Engine, where we decode the psychology of money in brutally honest terms. No fluff, no get-rich-quick schemes. Just the uncomfortable truths about why intelligent people make terrible money decisions. What you're about to hear isn't motivational content. These are documented psychological patterns from behavioral finance research, the same research that hedge funds use to predict human behavior and take your money. Here's the framework. 5 traps, 5 fixes. Each trap has cost the average person watching this over $100,000 in lost wealth over their lifetime. That's not a scare tactic. That's math. And we're going to prove it to you. Starting with the most dangerous trap of all. Trap 1, the intelligence illusion. And this is going to sting. Being smart makes you worse with money. Not better, worse. Let's prove it. A 20-year Dalbar study tracked actual investor returns versus market returns. The S&P 500 averaged about 9.5% annual returns. Want to guess what the average investor got? 3.8%. They underperformed by more than half, not because they were stupid, but because they were too smart for their own good. Here's what happens. Smart people read financial news. They analyze trends. They think, quote, I can see the pattern here. So they buy high when everyone's excited, panic sell when the market drops, and then spend the entire time trying to outsmart a system that doesn't care about their GPA. Meanwhile, the person who bought an S&P 500 index fund in 2003 and literally forgot about it, maybe they lost their login password, they crushed the smart investor by double digits. Warren Buffett has a $1 million bet proving this. He bet that a simple index fund would beat a portfolio of hedge funds managed by financial geniuses. He won. Easily. The paradox is brutal. The more you think you can outsmart the market, the more it destroys you. Smart people confuse complexity with competence. If they're not doing something clever, they feel like they're doing something wrong. Here's the fix. Embrace what we call weaponized simplicity. Right now, today, set up automatic investments into 3 low-cost index funds. 70% total stock market, 20% international, 10% bonds. Then delete the app from your phone. The less you think you can outsmart the system, the more money you'll make. Intelligence is your enemy here. Discipline is your weapon. Trap 2, lifestyle validation. This one is personal, this one hurts. You didn't spend 4 years in college and 6 figures on a degree to drive a Honda Civic. You didn't grind through medical school to live with roommates. You earned the right to look successful, right? Wrong. Dead wrong. And your bank account is screaming proof. Here's the data that should terrify you. 78% of workers making over $100,000 live paycheck to paycheck. Not $50,000, not $75,000, 6 figures. And they're broke. This isn't an income problem. This is a psychology problem. Every time you get a raise, your brain immediately recalibrates what normal spending looks like. You made $60,000, you spent $58,000. You got promoted to $90,000. Suddenly you're spending $88,000. New car lease, nicer apartment, better restaurants, and you're running faster, but you're not getting anywhere. Psychologists call this the hedonic treadmill. We call it the poverty trap for high earners. And here's the gut punch. The people you're trying to impress, they don't care. They're too busy trying to impress you with their own rented lifestyle. You're in a competition where everyone loses. Let's look at a real example. A 32-year-old software engineer making $180,000 a year, drives a BMW, lives in a luxury apartment, takes 3 international trips a year. Net worth? Negative $45,000. Compare that to a 34-year-old teacher making $52,000, drives a 2011 Camry, lives in a modest apartment, takes 1 beach trip a year, net worth $240,000. Same city, same age. The teacher will retire a millionaire. The engineer will work until they're 70. The difference? The teacher locked in their lifestyle. The engineer upgraded with every raise. Here's the fix. This is uncomfortable, but it works. When you get your next raise, and we mean the day you get it, make this commitment. Your lifestyle is frozen for the next 2 to 3 years. Same car, same apartment, same restaurants, same everything. Every extra dollar from that raise gets automated into 3 places before you ever see it. 50% to investment accounts, 30% to debt elimination, 20% to a future lifestyle upgrade fund. Here's what happens. In 3 years, you'll have $50,000 to $100,000 in investments working for you. Then, and only then, you can upgrade one thing. Not your entire lifestyle. One thing. The validation you're chasing fades in 6 months. The wealth you build lasts forever. Choose accordingly. Trap 3. Overconfidence bias. You're used to being the smartest person in the room. You solve problems other people couldn't. You pass tests other people failed. So when it comes to money, you assume you'll figure it out. The market is about to humble you. A landmark study in the Journal of Finance tracked 10,000 investors over 5 years. The researchers found something shocking. The most confident investors, the ones who said, "I know what I'm doing," had the worst returns. Not slightly worse, catastrophically worse. Why? They traded 50% more than cautious investors. Every trade meant fees. Every smart move meant timing risk. They were so confident in their ability to beat the market that they got crushed trying. Here's the trap. Your brain mistakes knowledge for skill. You read 3 articles about real estate, now you think you can flip houses. You understand blockchain technology, so you think you can time crypto. You took 1 economics class, so you think you can predict market movement. But knowing about something is not the same as being good at it. Someone can explain how LeBron James shoots a 3-pointer. That doesn't mean they should bet their retirement on making that shot. The market doesn't care about your degrees. It doesn't care about your IQ. It punishes overconfidence with mathematical precision. Here's a painful example. During the 2021 crypto boom, brilliant engineers, people who build AI systems, lost $100,000 or more because they were convinced they understood crypto better than the market. They knew the technology. They didn't know human behavior. The market ate them alive. Here's the fix. This requires ego death, but here it is. Assume you're average, not below average. Average. Because statistically, you are. Build a boring, diversified portfolio that assumes you have 0 special insight. 60% in broad market index funds, 25% in international stocks, 10% in bonds, 5% in play money where you can test your theories. That 5%, that's your tuition for learning why overconfidence is expensive. Lose it all, learn the lesson, but protect the other 95% from your ego. The goal isn't to be smarter than the market. The goal is to survive long enough for compound interest to make you rich, and compound interest doesn't care how smart you think you are. Trap 4, delayed reality. This is the silent killer. The trap you don't even know is closing until it's too late. Bad money decisions don't hurt you today. They don't hurt you tomorrow. They detonate in your face 10, 20, 30 years from now, when you can't fix them anymore. Let's show you what this means with some brutal math. You're 25 years old. You decide to skip retirement contributions because you'll catch up later. That decision right there just cost you $487,000 by age 65. Not because you spent the money, because you didn't invest it when time was on your side. $500 a month invested at 25 grows to $1.2 million by 65. That same 500 started at 35 grows to 470,000. Started at 45, 180,000. The difference between starting at 25 versus 35, over $700,000. Same monthly investment. The only difference is time. But here's why smart people fall into this trap. You're excellent at solving immediate problems. You aced the test. You fixed the bug. You closed the deal. Those problems gave you immediate feedback. Money is different. Money is a delayed consequence game. You max out a credit card at 22% interest. Doesn't hurt this month. Doesn't hurt next month. 5 years later, you've paid $8,000 in interest, and you still can't afford a house down payment. You lease a new car every 3 years. Feels affordable. Feels normal. But you just spent $150,000 over 20 years on vehicles you never owned, instead of investing that money and retiring a millionaire. A Northwestern Mutual study found that 21% of Americans have 0 retirement savings. Not because they're dumb, because the pain is invisible until it becomes catastrophic. The future version of you, 60-year-old you, 70-year-old you, is screaming back through time trying to tell you this matters, but you can't hear them because the consequences are silent. Here's the fix. Make future pain visible right now. Go to a compound interest calculator. Links are in the description. Plug in these numbers. Monthly investment, $500. Years, 30. Return rate, 8%. Watch what happens. That's $745,000. That's your future. Now remove 5 years. Watch $250,000 disappear. Make it hurt. Make it real. Then automate that $500 into your investment account before you can spend it. You cannot rely on future you to be disciplined. Future you will have the same excuses, the same just this once rationalizations. Present you has to lock this in and remove the choice. Set up the automatic transfer today, not tomorrow. Today, because every month you wait costs you $3,000 in future wealth. Trap 5, fear of simplicity. And this might be the most frustrating one. Smart people hate simple answers. If wealth building was as basic as spend less than you earn and invest the difference, everyone would be rich, right? So there must be more to it. A secret strategy, a hidden loophole, an advanced technique only the smartest can master. There isn't. Morgan Housel, who wrote The Psychology of Money, said, quote, "Doing well with money has little to do with how smart you are and a lot to do with how you behave." The wealthiest people don't have complex strategies. They have boring, consistent habits repeated for 30 years. Here's the uncomfortable truth. You don't need a PhD in finance. You don't need to understand options trading. You don't need to time the market or find the next Amazon. You need exactly three things. One, spend less than you earn. Two, invest the difference in low-cost index funds. Three, don't touch it for 30 years. That's it. That's the entire strategy. It's so simple, it feels like we're lying to you. But smart people reject this because it doesn't feel sophisticated enough to work. It doesn't match their self-image as someone who solves complex problems. So they complicate it. They watch YouTube videos about day trading. They join crypto Discord servers. They research individual stocks. They create elaborate spreadsheets. And they lose. Because wealth building isn't complicated. It's just boring. And smart people would rather lose money doing something interesting than make money doing something simple. Let's give you the math that proves this. The median day trader loses money. The average crypto trader loses money. The typical stock picker underperforms index funds. But the person who buys VTI and forgets about it, they beat 90% of professional investors over 30 years. The strategy that works is so simple it feels like cheating. But it only feels like cheating because you've been told investing should be hard. Here's the fix. Accept that wealth building is supposed to be boring. If your money strategy is exciting, you're probably losing. Here's your simple, boring wealth building system. Step 1. Set up automatic transfers on payday. 20% to Vanguard Total Stock Market Index Fund, ticker VTI. 10% to High Yield Savings for Emergency Fund. Step 2. Delete all investing apps from your phone. Step 3. Check your accounts once per quarter, not daily. Once per quarter. Step 4, never sell. Not in a crash, not in a boom, never. That's it. That's the system that has created more millionaires than every get-rich-quick scheme combined. The goal isn't to beat the market. The goal is to let time and compound interest do what they do automatically while you focus on earning more income and living your life. Boring wins. Complexity loses. Choose accordingly. Let's lock this in. 5 traps that keep smart people broke. Trap 1. The intelligence illusion. Being smart makes you overconfident. The fix? Automate simple index fund investing and step away. Trap 2. Lifestyle validation. Every raise becomes lifestyle inflation. The fix? Lock your lifestyle for 2 to 3 years after raises. Trap 3. Overconfidence. Bias. You think you can beat the market. The fix? Assume you're average. Build a boring portfolio. Trap 4. Delayed reality. Bad decisions don't hurt until it's too late. The fix? Make future pain visible now. Automate investments today. Trap 5. Fear of simplicity. You reject simple strategies. The fix? Accept that boring wins. Set it. Forget it. Here's what you need to do right now. First, comment which trap hit hardest for you. Just type the number 1 through 5. Every comment gets a reply. Second, if you're committing to one of these fixes this week, comment locked in and tell us which fix you're implementing. Third, here's the thing. These 5 traps, they're just the surface. The wealthy don't just avoid these traps. They use the financial system itself as a cheat code. Tax strategies, entity structures, cash flow optimization. That's exactly what we're breaking down in the next video. If you want to understand how the 1% legally game the system to build wealth faster, hit that subscribe button. The algorithm will show it to you. Now go automate something. Your future self is counting on you.